What exactly is Sun Country Airlines? What kind of company are we talking about here, beyond just SNCY?
Okay, so foundationally, SNCY falls under the industrial sector, specifically airlines,
Makes sense.
and they operate primarily out of Minneapolis, Minnesota. The company itself, it's relatively young, established late 2017.
Okay, so not one of the really old legacy carriers.
No, definitely not. And then they went public, had their IPO in March of 2021, so still fairly new to the public markets.
Got it. 2017 founding, 2021 IPO. And their business, what do you actually do?
Well, that's a good starting point because Sun Country isn't just, another standard airline. It operates with a distinct, almost kind of hybrid business model.
Hybrid. How so?
While many might think of them purely as a passenger carrier, our sources highlight three core operational segments.
Okay.
You've got scheduled passenger service, like a typical airline, then charter air transportation, flying specific groups, teams, that sort of thing.
Right.
And then, crucially, a dedicated cargo business. Now, it's true that the passenger segment, both scheduled and charter combined, still generates the majority of their revenue currently.
Okay, so passengers are still king for now.
For now, yeah. But the diversification offered by that cargo business is becoming, well, increasingly central to their identity, especially for a company described as a low-cost air carrier.
Ah, interesting. So low-cost model, but with this cargo twist.
Exactly. This dual focus helps them, potentially hedge against the ups and downs, the cyclical nature of traditional passenger demand. And as we'll definitely get into later, it's become a really significant growth engine for them.
So it's far more than just getting people from point A to point B. They've built this significant operation around hauling freight, too. That feels quite different from many traditional airlines.
It is, especially for a carrier positioning itself as low cost. It adds another layer.
And in terms of scale, how big are they? Workforce.
They're a substantial employer in the sector.
Mhm.
Our sources indicate their workforce fluctuates somewhere between roughly 3,141 and 3,293 employees.
Okay, so a decent size.
Yeah, and for a low-cost carrier, that suggests a lean but, robust operational footprint. Furthermore, their geographical segments, they're predominantly focused on domestic routes and Latin America.
Domestic and Latin America.
Right.
So not really going head-to-head with the giants on, say, transatlantic routes.
Precisely. This strategic focus implies they've carved out a specific niche, often targeting leisure travelers, specific regional markets, that kind of thing. They're not trying to be everything to everyone.
Makes sense. Avoid the direct dogfight.
Right. This tailored approach, combined with their growing cargo operations, allows them to potentially exploit different demand patterns, different operational efficiencies than their larger counterparts might. It's a pretty precise market niche they've cultivated, aiming for profitability through that specific blend of services and geographies.
Okay, here's where it gets really interesting, right? Let's peel back the layers and understand Sun Country's financial heartbeat.
The numbers.
Exactly. What do the valuation ratios, the income figures, tell us about its current state and how the market perceives its value?
Let's dive in.
Okay, so current snapshot. As of the close on August 18th, the stock, SNCY, stood at $12.22 per share. That gives it a market capitalization of $651.53 million.
Right, market cap under $1 billion.
But to get a truly comprehensive sense of the company's total value, especially for an industry like airlines that often carries significant debt.
You need enterprise value.
Exactly. We need to look at its enterprise value, which comes in higher, at $1.06 billion. This gives us that broader view, factoring in both the equity and the debt.
Yeah, enterprise value is crucial for capital-intensive businesses like airlines. It gives you that complete picture of what it would really cost to acquire the whole company, debt and all. It's often a better comparison tool.
Got it. So $1.06 billion enterprise value. Now turning to the valuation ratios. These always provide some compelling insights into market expectations, don't they?
They really do. Let's start with the traditional price to earnings, the PE ratio. Looking backwards, based on past performance, it's 11.48.
11.48. Okay. Seems reasonable enough on the surface.
It does. But what immediately jumps out, really jumps out, is the forward PE. This looks ahead, forecasting earnings for the coming year.
Yeah.
It's significantly lower. It stands at just 6.64.
Wow. 11.48 trailing, 6.64 forward. It's a big drop.
It's not just a slight difference. It's a strong indication that the market is anticipating a substantial increase in Sun Country's earnings. Very near future.
So forward-looking optimism, contrasting sharply with the trailing numbers.
Precisely. Suggest maybe the past performance isn't indicative of where things are headed.
That forward PZ is essentially Wall Street's crystal ball then, isn't it? Peering into what they think is coming down the runway.
You could say that. And the PEG ratio. This really puts a spotlight on that future expectation.
Okay, the PEG. What's that telling us?
It's remarkably low, 0.37.
0.37. That is low.
It is. To put that into perspective, the PEG ratio combines the PE with the expected earnings growth rate. A ratio below 1 often suggests a stock might be undervalued relative to its projected growth.
Then 0.37 is way below 1. Way below. For SNCY, that 0.37, it's almost like you're paying very little today for potentially a significant amount of anticipated future performance. It signals that the market might not yet be fully appreciating, or maybe not fully pricing in, the robust growth Sun Country is expected to deliver.
Okay, so that's a key potential undervalued signal right there, a real nugget, like you said earlier.
It immediately catches the eye for any investor looking at growth versus price.
That's a fascinating insight. Okay, beyond earnings, what about ratios tied to revenue and assets? We're looking at price to sales, PS, of 0.59.
Right, PS under 1.
And price to book, PB, of 1.06. Pretty close to 1.
Very close.
And then there's price to cash, PC, at 4.21, and price to free cash flow, PFCF, at 4.94. How do these kind of round out the valuation picture?
Okay, so these offer different but equally important perspectives. A PS of 0.59 indicates the market values Sun Country at less than 1 times its annual sales.
Which sounds low. Well, for an airline, where revenue per passenger or per cargo ton can be subject to intense competition pricing pressures, a PS below 1 can suggest either, yes, tight margins, or maybe that the market isn't fully recognizing the company's revenue generation potential yet.
Okay. And the PB?
Close to 1. The PB of 1.06, comparing stock price to the company's book value per share. Being close to 1 means the stock is trading near the accounting value of its assets.
Which are mostly planes, I assume.
Exactly. For an asset-heavy industry like airlines, where planes and infrastructure make up a huge part of the book value, this isn't excessively high. It suggests the market isn't wildly speculating on the asset value, but valuing them close to their recorded worth.
Makes sense. And what about those cash flow metrics?
Yeah.
PC and PFCF, they often give a more direct look at the actual cash generation, right?
Absolutely. Cash is king, especially in capital-intensive industries. The PC of 4.21 and especially the PFCF of 4.94 are particularly illuminating for an airline.
Why especially PFCF?
Because free cash flow is the pure cash a company generates after covering all its operational expenses and its capital expenditures, buying new planes, maintaining the fleet, big costs for airlines.
Right, CapEx is huge.
So a low PFCF, like Sun Country's 4.94, suggests very efficient cash generation relative to its share price.
Which is good.
It's crucial. In an industry like airlines, which demands significant capital outlays, strong free cash flow means the company has more flexibility. They can fund their own growth, pay down debt, maybe even return capital to shareholders eventually, rather than constantly relying on external financing.
Okay, so it speaks to the health and self-sufficiency of their core operations. Good cash generation.
Exactly. It's not just profit on paper, it's cash they can actually use.
So wrapping up valuation, those enterprise value ratios we mentioned earlier, EV/EBITDA at 5.09 and EV sales at 0.96, how do these fit into the puzzle, especially for an airline?
These are often the preferred metrics for analyzing industries like airlines, precisely because they factor in debt and strip out noise like depreciation and amortization, which are huge for airlines due to the planes.
Right. Gets closer to operational performance.
Exactly. And a EBITDA of 5.09 is generally considered quite reasonable, maybe even attractive, for an airline. It indicates the total value of the company is roughly 5 times its operational earnings before interest, taxes, depreciation, and amortization.
And the EV sales under 1.
Coupled with an EV sales of 0.96, these figures suggest that even when you account for its debt, Sun Country's overall valuation appears fairly balanced relative to its operational earnings and sales.
Okay.
For you, the listener, these metrics provide a more holistic, often more accurate picture of a company's true value in these asset-heavy, debt-laden businesses compared to just looking at market cap alone. They reinforce the idea that, from a valuation standpoint, SNCY seems priced quite reasonably given its operational performance.
Okay, we've painted a detailed financial portrait of SNCY as it stands today, and those valuation ratios, especially the forward PE and that super low PEG, certainly hinted at some exciting future prospects.
Definitely pointed towards growth expectations.
But to truly understand where Sun Country is headed, we need to move beyond static snapshots. So the crucial question now is, how has SNCY been growing, and what do the forecasts suggest for its future? especially considering some of those intriguing numbers.
Right, the historical versus the projected.
Their EPS, earnings per share, over the trailing 12 months is $1.06. But here's where the narrative gets complex, right? Their past 3-year EPS growth was actually negative, at negative 11.14%.
Ouch. Negative 11%.
Yeah. Though, interestingly, the 5-year growth was positive at 3.58%. So it paints a very mixed picture historically, wouldn't you say?
It absolutely does. And this is precisely where the story of Sun Country, I think, truly begins to unfold. It reveals a company in significant transition. You have this stark contrast. Recent historical period, negative EPS growth over 3 years, which might give any investor pause, naturally.
For sure.
And then you look at the future EPS projections, and they are, well, nothing short of remarkably optimistic.
How optimistic are we talking?
Wall Street analysts are forecasting EPS for next year to hit an impressive $1.84.
$1.84, up from $1.06 trailing.
Exactly, which translates to a projected growth of a whopping 56.03%.
56% growth. Wow.
And looking even further out, EPS for the next 5 years is projected to grow at an average of 30.85% annually.
30% annual growth for 5 years.
Yeah.
That's huge.
It is. And for the immediate next quarter, EPS is projected at $0.11. This isn't just a slight uptick we're seeing projected here. It's a fundamental shift they're expecting.
Wow, that's quite the turnaround from that negative 3-year number. It almost sounds like a company undergoing a major transformation, like finding a new gear or something.
That's a good way to put it.
What exactly could be driving such an incredibly optimistic outlook after that negative stretch?
This dramatic contrast strongly suggests, a significant inflection point. A fundamental shift in their business strategy or maybe market conditions that analysts believe will just propel them forward.
And based on the sources, what's the key driver?
When we connect this to the broader picture, the news, the earnings calls, a key driver is undoubtedly the company's strategic pivot and significant expansion of its cargo business.
Ah, the cargo again.
Yes. The Q2 2025 earnings call, for example, explicitly highlighted record cargo revenue. This isn't just a minor sideline anymore. It's being positioned as a powerful, accelerating engine for future growth.
So potentially overshadowing the challenges they faced in the traditional passenger segment over the past 3 years, especially with all the pandemic volatility.
Exactly. That cargo emphasis appears to be a calculated and seemingly successful strategic pivot.
Okay. And it's not just earnings. Sales growth is also part of this story, right? Reinforcing the narrative.
Absolutely. Sales growth provides context.
Their current sales stand at $1.1 billion. Over the past 3 years, sales growth was a solid 19.97%.
Almost 20% growth. Pretty good.
And looking longer term, over 5 years, it was 8.93%. So sales have consistently been moving in the right direction, even when EPS struggled recently.
That's an astute observation. The consistent sales growth, even during periods of EPS decline, hints at maybe an underlying operational strength that wasn't always translating to the bottom line. Perhaps due to cost pressures or investments being made.
Right, in investing in that cargo transition maybe.
Could be. But the recent quarterly surprises really underscore the current positive momentum. We saw a massive EPS quarter-over-quarter growth of 262.84%.
262% QQ. Huge beat.
Huge. And sales quarter-over-quarter growth of 3.63%. Furthermore, the EPS surprise percentage was 24.11%.
Meaning they beat analysts' expectations by 24%.
Correct. Significantly exceeded expectations. And the sales surprise was 2.98%, so a beat on the top line too.
Okay, so consistent beats recently.
These consistent beats on both earnings and revenue, combined with that strategic focus on the lucrative cargo segment, help explain why analysts are so optimistic about their future growth trajectory. It strongly implies successful strategic execution that is now starting to show up dramatically in the numbers.
Suggesting the company has potentially found its stride in a new, more profitable direction.
That seems to be the narrative the numbers are supporting, yes.
Okay, so growth looks potentially explosive, driven by cargo. But it's not just about how much money comes in, is it? It's about how much actually sticks around as profit.
Absolutely. Efficiency matters a lot.
So how efficient is Sun Country Airlines at turning all that revenue from passengers and their expanding cargo business into actual tangible profit? Let's talk margins.
Okay, margins tell a big part of the story.
Their gross margin is 23.14%.
23% gross. That's the revenue left after the direct costs of flying fuel, flight crew, direct maintenance.
Right, the cost of goods sold, basically.
Pretty much. For an airline where fuel and labor are massive, often volatile expenses, A gross margin in the low 20s is, well, quite respectable. It signals disciplined control over those core operational costs, suggests they're running their flights and cargo transport pretty efficiently.
Okay, so managing direct flight costs well. What about beyond that, when you factor in all the other business expenses?
Right, that's where the operating margin comes in. It's 10.09%.
10% operating margin. How does that stack up?
This metric tells us what percentage of revenue remains after covering not just direct costs, but also all the other operating expenses, admin salaries, marketing, ground crew overhead, sales efforts, everything else needed to run the business day to day.
Okay.
Now, for an airline, hitting a double-digit operating margin like 10% is quite robust. Many airlines, especially low-cost carriers, often struggle to consistently achieve this. There's intense competition, high fixed costs, the inherent volatility.
Yeah, it's a tough industry.
It is. So Sun Country's 10.09% suggests pretty disciplined cost management beyond just the immediate flight ops, speaks to the efficiency of their overall business model, lean and effective.
Okay, good operating efficiency. And the final bottom line, profit margin.
The profit margin is 5.35%. This is the ultimate bottom line, how much profit the company makes for every dollar of revenue after all expenses, including taxes and interest on their debt, have been deducted.
5.35%. So roughly a nickel of profit for every dollar of sales.
That's right. It's the final measure of how much cash actually converts to shareholder value, theoretically.
Okay, that puts these numbers into valuable context for an airline. Now, beyond just margins, how efficiently are they deploying their assets and shareholder capital to generate those profits?
Good question. We need to look at the return ratios.
We have return on assets ROA at 3.73%, return on equity ROE at 10.15%, and return on invested capital ROIC at 5.58%. What do these return ratios really tell us?
Think of these as gauges of how much bang for the buck Sun Country is getting from its investments. ROA of 3.73% measures how efficiently management is using its substantial asset base, mostly aircraft, to generate earnings.
So getting 3.7 cents of profit for every dollar of assets.
Roughly, yes. For an asset-heavy industry like airlines, where billions are tied up in equipment, a positive ROA like this is a good sign. Shows they are successfully generating profit from their planes and infrastructure. Productive asset utilization.
Okay, and what about ROE? That's often seen as a key measure for shareholders, right?
ROE at 10.15% is particularly important for you, the listener, as a potential shareholder. It indicates how much profit the company makes for every dollar of shareholder equity.
And 10%, that's decent.
A double-digit ROE is generally viewed quite favorably, suggests good returns on the capital directly invested by owners, speaks to the company's ability to generate profit from the money shareholders have put into the business.
Got it. And finally, ROIC, 5.50%.
ROIC is a more comprehensive measure. It evaluates the return a company makes from all capital that has been invested, both debt and equity. It's a broader look at how efficiently the company is allocating all forms of capital to generate returns for both shareholders and creditors.
So ROE for owners, ROIC for everyone providing capital?
Essentially, yeah. These return ratios collectively suggest that SNCY is not just making a profit, but doing so with a reasonable degree of efficiency in utilizing its capital and assets. That's a positive sign for long-term sustainability in a very demanding industry.
Okay, profitability and efficiency seem reasonably solid, especially that operating margin. But beyond profitability, we absolutely need to consider the company's overall financial health.
Right, risk assessment, debt and liquidity.
Exactly. How well can it cover its short-term obligations?
Mm-hmm.
And what's its debt picture look like? It's starting with liquidity. The quick ratio is 0.59, and the current ratio is 0.63.
Both below 1.
Yeah, both below 1. Now, for some industries, ratios below 1 might be a screening red flag, but I understand it's maybe not uncommon for airlines. Can you elaborate on what these imply for Sun Country?
That's a crucial distinction, and you've hit on a common point. For industries like airlines, where cash flow is incredibly dynamic, operations are high volume, it's actually not unusual to see liquidity ratios below 1.
Why is that?
Airlines often operate with what's called negative working capital. This means their current liabilities think unearned revenue from tickets sold way in advance can exceed their current assets, which are often quickly converted into cash through daily operations. People pay upfront for flights they haven't taken yet.
Ah, okay, so the cash comes in before the service is delivered?
Exactly. So the quick ratio, which is even stricter because it excludes inventory, and the current ratio both being below 1, It implies that while they might not have a huge immediate cash cushion sitting there for unexpected large short-term demands,
They don't have tons of cash just lying around relative to upcoming bills.
right, but it's typical for their operational model to cycle cash very quickly, generating revenue up front. So what this implies for you is that while these numbers aren't inherently alarming for this specific industry, it's certainly something to keep an eye on.
Meaning?
Meaning you want to be sure they maintain sufficient operational cash flow through efficient daily management, rather than relying on a large static cash reserve they don't seem to have. It depends on continuous operations running smoothly.
Okay, so less about a direct red flag, more about understanding the unique rhythm of their cash flow. Critical nuance there. Now, what about the debt?
Always a big topic for airlines.
Debt levels can be a major factor given the capital intensity buying and maintaining all those planes. Their debt to equity is 0.92 and long-term debt to equity is 0.75. What do these tell us?
These debt ratios are indeed significant indicators of their financing structure. A debt-equity ratio of 0.92 means that for every dollar of equity, the company has 92 cents of debt. So pretty balanced.
Almost 1-to-1.
Almost. And the long-term debt equity at 0.75 specifically focuses on obligations due in more than a year. These numbers indicate that, yeah, a notable portion of the company's assets are financed through debt rather than shareholder equity.
Which is normal for airlines, you said.
Extremely common, often necessary for growth, fleet modernization. You need debt to buy multi-million-dollar aircraft, usually. The key here is whether this debt load is manageable given their cash flow and earnings, which, as we've discussed, have shown positive trends recently.
So is 0.92 manageable?
A ratio around 1 or slightly below like this suggests a relatively balanced approach between debt and equity financing. It doesn't necessarily scream excessive leverage, especially in this industry, but it's definitely a factor in their risk profile, something to monitor to ensure it doesn't become burdensome if, say, interest rates spike or earnings falter.
Got it. Balanced but needs watching. And speaking of risk, we also have a beta of 1.62.
Ah, beta. Volatility measure.
Right. For those less familiar, what does that beta number precisely tell us about investing in SNCY?
Beta is a widely used measure of a stock's volatility, its systematic risk relative to the overall market, often represented by the S&P 500.
And 1.62 means?
A beta of 1.62 means that SNCY stock tends to move 1.62 times as much as the broader market, historically. So if the S&P 500 goes up by 1%, SNCY stock would theoretically tend to go up by 1.62%.
Okay, amplified upside.
But also, conversely, if the market drops by 1%, SNCY could drop by 1.62%. It signifies higher volatility compared to the overall market, larger price swings both up and down.
So higher risk.
For you, the listener, yes, this means the stock presents a higher risk profile due to its amplified movements relative to general market trends. But it also offers the potential for higher returns during bull markets. It's definitely not for the faint of heart. Suggests a more turbulent ride compared to just buying a broad market index fund.
Okay, now let's peel back another layer. This is always fascinating. Who actually owns Sun Country Airlines? And crucially, what have those with the most insight, the insiders, the major institutions, been doing with their shares?
Yeah, following the smart money, so to speak.
We see that insider ownership stands at 13.27%. That's a decent chunk, right? Shows some skin in the game from management.
13% is significant, yes. Indicates alignment.
But then institutional ownership is remarkably high at 113.57%.
Oh, over 100%.
Yeah, that number always raises eyebrows. How can institutions own more than 100% of a company? It sounds impossible.
It does sound weird, doesn't it? That's a great question, and it's a common point of confusion. Institutional ownership exceeding 100% is actually a known quirk of how these numbers get reported and aggregated.
A quirk?
Yeah, it doesn't mean they've found extra shares hidden somewhere. It often arises because of reporting mechanics. For example, some institutions might report ownership of shares that are simultaneously lent out for short selling. Or you have complex derivative holdings like options or convertibles that represent an interest in more shares than are technically outstanding at that moment.
So it's about reporting rules, short positions, derivatives, things like that.
Exactly. So while it sounds counterintuitive, it's generally a result of these reporting mechanics and market activities rather than anything nefarious. It's a data point that signals significant institutional interest and activity, but you shouldn't interpret the over 100% as a literal impossibility. It just shows a lot of institutional involvement.
Fascinating. Okay, good clarification. It's more about the complex plumbing of the market than magic shares. Now, let's dive into what the insiders have been doing. the folks running the show.
Right, the execs and directors.
The insider transactions percentage is negative 0.25%, negative 0.25%. That indicates a net insider selling trend, right? More selling than buying overall.
Correct, net selling.
And when we really dig into the specific examples from the insider trading table provided, there's a pretty clear and consistent pattern here. It's not just one person selling a few shares. It's multiple key executives selling repeatedly throughout early to mid-2025. This seems like a significant data point to consider.
This is a critical piece of the puzzle, I agree, and it absolutely warrants a very close look. We're seeing consistent, repeated sales from high-level executives. When you view that in aggregate, it becomes quite noteworthy.
Like who, specifically?
For instance, the CEO, Jude Bricker. He's made multiple sales. Our data shows 2,103 shares sold in July 2025 for almost $25,000. And earlier, 2,172 shares in April 2025 for over $26,000.
Okay, so consistent, relatively small sales from the top boss.
They aren't huge block trades, no, but it's the pattern of gradual divestment from the very top that's interesting.
And it's not just the CEO, right? The president and CFO, David M. Davis, also appears prominently in the sales column. And with some pretty substantial figures, actually.
Absolutely. David M. Davis has numerous sales on record. One example, 1,449 shares in April 2025 for about $17,400. Similar size to the CEO's trades. But even more significantly, he executed a very large sale, 59,389 shares, back in January 2025.
Wow, nearly 60,000 shares. How much was that worth?
That totaled over $1 million.
$1 million. Okay, that is substantial, especially from the CFO.
That's a significant amount of capital. Represents a meaningful portion of holdings, presumably. Such large transactions from a key financial officer naturally draw attention.
And the pattern continues, doesn't it? The Chief Accounting Officer and VP of Finance, John Jirchi, what's his activity look like? Suggesting this is broader among leadership.
John Jirchi also shows a consistent pattern of sales, reflecting that collective trend. For example, 309 shares in July 2025 for about $3,600. Again, a much larger transaction earlier. 27,482 shares in January 2025 for nearly $470,000.
Okay, another big sale in January. Seems like January was a popular time to sell.
It does seem that way, and it's not just a one-off for him either. It's regular shedding of shares. Beyond these key figures, our sources also show sales from other notable officers: Chief Revenue Officer and SVP Whitney Grant, Interim CFO William Trousdale, SVP, Chief Legal Officer Aaron Rose Neal, Chief Operating Officer and EVP Gregory Ames.
Wow, okay, so it really is widespread across the C-suite and senior VPs.
The breadth of these sales across multiple high-level executives is what makes this pattern particularly noteworthy for you, the listener. It's just a more widespread action within the leadership team rather than just isolated individual financial planning decisions.
So it's not just one person making a personal choice, but feels more like a collective action.
Yeah.
And crucially, there was also that massive sale by a major holder, SCA Horace Holdings, LLC. That sounds like a private equity or initial investor, maybe?
That's a very important detail, yes. And it ties into a broader corporate finance event we should mention. SCA Horace Holdings, LLC, conducted a truly significant sale over 6.3 million shares back in February 2025.
6.3 million shares.
Yeah, bringing in over $100 million for them.
Okay, that dwarfs the executive sales.
Absolutely. And this was directly related to a secondary public offering, a major event where a large existing shareholder sells a big block of shares to the public market, effectively redistributing ownership.
Ah, so maybe an early investor cashing out some of their stake now that the company's public and established.
That's often the case with secondary offerings involving large initial shareholders like private equity firms. Now, what does all this widespread insider selling, both by individual executives and this major holding company, imply for you, the listener?
Yeah, what's the takeaway? Is it a huge red flag?
Well, it's never a definitive sell signal on its own. Insiders sell shares for a multitude of perfectly legitimate reasons. Personal financial planning, maybe buying a house, diversifying their portfolios, which might be heavily concentrated in company stock, or exercising stock options that convert to shares they then sell for liquidity. Lots of reasons.
Right, it's not always negative news.
However, a consistent pattern of selling from multiple high-level executives, that is undeniably a data point worth noting. It's a piece of information that needs to be carefully balanced against those otherwise positive growth forecasts and the favorable analyst recommendations we'll get to.
So balance the optimism with the fact that insiders are selling.
Exactly. It's not a direct indictment of the company's future necessarily, but it is a signal that those closest to the company are, to some extent, taking some chips off the table. And that's a data point that deserves your attention. You have to ask why, even if there are benign explanations.
Okay, insider selling is definitely something to chew on. Now, let's shift focus to the market's verdict. How has SNCY stock actually been performing recently? And what are the analysts, the professional stock watchers on Wall Street, saying about its future direction?
Right. The market reaction and the expert opinions.
Looking at the stock performance, well, it's a bit of a mixed bag, isn't it?
Yeah.
There's a strong perf week of 12.73%. That suggests some recent positive momentum.
Yeah, a nice pop in the last week.
But then perf month is actually negative 2.08%. So those weekly gains didn't quite hold up over the full month.
It truly is a dynamic picture, indicates some definite short-term volatility. A stock that responds quite sensitively to news, maybe, or broader market trends, while a nearly 13% jump in a week is impressive, catches the eye. The slight dip over the month suggests those gains might not be holding steadily. Could be profit-taking after the jump or reaction to other news, perhaps.
Okay, what about looking a bit further out? Quarter, half year, year to date?
When we zoom out to the perf quarter, it's pretty flat. A modest 0.99% gain. But then the perf half year drops significantly, down 29.28%.
Oof, nearly 30% down in 6 months.
Yeah. And year-to-date is also down, negative 16.19%. This tells a story of, well, significant headwinds or a challenging period for the stock over the past 6 months to a year.
Those longer-term figures, especially the half year, suggest quite a plunge. Tough period for investors who bought earlier in the year, but then intriguingly, the perf year jumps back up to positive 31.54%.
Right. So despite being down YTD in over 6 months, it's up nicely over the full year.
Which is great, but that positive year is contrasted sharply with a 3-year performance of negative 38.31%.
Okay, so big picture. Down significantly over 3 years, but recovered a lot of ground in the last 12 months, yet still down from the start of this year.
Exactly. It's quite the roller coaster, a real up and down chart.
It is. This performance history paints a very clear picture. Significant volatility, a challenging period over the medium term, 3 years, followed by a more recent resurgence in the last year, but then more recent weakness again.
Where does the price sit now relative to its highs and lows?
The current price, $12.22, is 34.26% below its 52-week high of $18.59, so well off the peak. But it's also a healthy 50.86% above its 52-week low of $8.10.
Okay, so bounced strongly off the bottom, but still way off the top. Really underscores the swings.
Absolutely. And this volatility is further confirmed by its daily volatility metric of 6.79% and monthly volatility of 5.26%. These numbers are high.
High volatility.
It aligns perfectly with that high beta of 1.62 we discussed earlier. Reinforces the idea that this stock just moves more dramatically than the overall market. For you, the listener, understanding this inherent volatility is paramount. It offers both amplified opportunity and amplified risk.
So if you like a dynamic, maybe sometimes turbulent investment, SNCY might fit, but definitely not a smooth, steady flight path for the stock price.
Not at all.
What about the analyst outlook then? What's the collective wisdom of Wall Street telling us about its future direction? Do they see it going back towards the highs?
The overall analyst recommendation, averaged across various firms, stands at 1.56.
1.56. What does that scale mean?
Usually 1 is a strong buy, 2 is buy, 3 is hold, 4 sell, 5 strong sell. So 1.56 generally leans towards a buy rating. Pretty positive overall sentiment.
Okay, leaning buy. And the target price?
The current consensus target price is $16.67.
$16.67. So analysts see decent upside from the current $12.22 price, about 36% upside potential to the consensus target.
That's the average view, yes. However, it's crucial to look beyond just this average. You need to consider the range of opinions and how they've evolved over time. Analysts shift their views.
Right. What have some of the recent actions been?
We've seen a variety of actions. TD Cowen, for instance, has reiterated a buy rating multiple times. But they've adjusted their price targets along the way, went from $14 up to $20, then later adjusted from $22 down to $17. Reflects an evolving assessment, maybe reacting to performance or news?
Okay, so even the bulls adjust their targets.
Right. JP Morgan initiated coverage with an overweight rating that's basically a buy and a robust $23 target. Quite optimistic.
$23, ambitious.
On the other hand, Goldman Sachs resumed coverage with a more cautious neutral rating that's like a hold and targets ranging from $17 to $19 over time.
So a lot of movement and different takes even among the big names. It's definitely not a uniform chorus of buy.
Precisely. We also saw Wolfe Research upgrade them to outperform, a buy equivalent, and Morgan Stanley upgrade to overweight, another buy. That signals growing confidence from some quarters.
Okay, more upgrades.
But then counterbalancing that, we also observed Susquehanna downgrade them to neutral.
So upgrades and downgrades. Bulls and more cautious observers.
Exactly. This wide range of analyst opinions, from clear buy to neutral, and these varying price targets. It indicates that even among seasoned professionals who analyze these companies daily, there's no single unanimous view on SNCY's future.
Reinforces the idea that it's complex. Opportunities and challenges.
Right. It's a company with significant opportunities, especially that unique business model and growth potential, but also notable complexities and risks which warrant careful consideration. And remember that high beta of 1.62.
The volatility.
It confirms it. While broader market sentiment can lift all boats, SNCY's boat tends to rise and fall more dramatically. Higher highs maybe, but potentially lower lows too. It amplifies everything. For you, the listener, understanding this is key when evaluating SNCY.
Okay, the market picture is volatile.
Yeah.
Analysts are generally positive but not unanimous, and insiders have been selling. Numbers tell us what is happening, but news often tells us why. Let's try to tie these metrics and market performance observations to the real-world events, the strategic decisions that have shaped Sun Country's recent journey.
Connecting the dots between the data and the story.
And one theme that keeps popping up in the sources, almost constantly it feels like, is the Amazon cargo partnership. This really isn't just a side gig for them anymore, is it? Seems absolutely foundational.
Not at all. You've perfectly captured its significance. The Amazon cargo partnership appears to be a major, maybe the major, transformative strategic pillar for Sun Country right now.
How so? What do the sources say?
Our sources show just how rapidly this segment is intended to grow. Back in August 2024, Amazon was projected to generate about 20% of Sun Country's total revenue.
20% is already significant.
It is. But fast forward just a few months to February 2025, and SNCY was explicitly stating they expected to double cargo revenue thanks to Amazon fleet additions.
Double from an already significant base. Wow.
Yeah. This is a massive leap in emphasis. Suggests a significant rebalancing of their entire business model, strategically moving beyond just relying on passenger travel.
And we heard more about that specific deal back in June 2024, didn't we? Something about a revised agreement, boosting cargo profits specifically.
Yes, exactly. The news specifically mentioned a revised Amazon deal that was expected to boost cargo profits, not just revenue. And crucially, Amazon was also transferring Boeing 737-800 cargo jets directly to Sun Country.
So Amazon is providing the planes.
Providing some of the planes, yes, which directly enhances SNCY's operational capacity in this high-growth segment. And this connects directly back to that Q2 2025 earnings call we mentioned.
Where they highlighted record cargo revenue.
Precisely. This isn't just strategic talk or projections anymore. It indicates that the decisive shift into cargo, particularly with Amazon, is yielding tangible, significant financial results. It's directly underpinning those strong forward growth projections we discussed.
Okay, so the strategy seems to be working, paying off on the cargo front.
It suggests the company is effectively capitalizing on a major market opportunity there.
So the cargo business is clearly a powerful driver. Beyond that, what about their earnings performance more broadly? Have they consistently been hitting their financial targets recently or even exceeding them?
They have demonstrated a consistent and, frankly, impressive trend of beating earnings and revenue estimates lately.
Really? Consistently?
Yes. Our sources like Guru Focus and Zacks indicate that Q2 2025, Q1 2025, and Q4 2024 all reported beats on both counts, earnings and revenue, often accompanied by management declarations of record revenue.
Okay, 3 quarters in a row of beats? Maybe more.
This consistent outperformance, along with Wall Street analysts anticipating strong earnings growth leading up to these reports, it suggests pretty solid execution against expectations.
Which must build confidence, right?
It builds significant investor confidence when a company repeatedly delivers, especially exceeding what the market is anticipating. Particularly after that period of mixed historical EPS growth we saw earlier, shows they can deliver now.
Okay, makes sense. Beyond the financials and the pivotal cargo segment, what about broader operational developments? Are they expanding routes, improving the customer experience, making other changes?
They are very actively managing their operational footprint and customer touchpoints, yes. We've seen proactive schedule extensions, planning flights out through summer 2025, fall 2025, and even into winter and spring 2026 already.
Planning that far ahead implies confidence.
It implies strong confidence in forward bookings and sustained demand for their services across multiple seasons. That's generally a positive sign.
Any changes in leadership?
On the corporate leadership side, yes, there was a notable change. Appointment of a new CFO, Dietork Zubek, in August 2025.
New CFO. That can often signal a shift.
Sometimes it can signal a strategic reorientation, maybe a renewed focus on specific financial objectives, or just normal succession planning. Hard to say definitively without more context, but it's a key change.
Any operational hiccups mentioned? Airlines always seem to have some.
They've navigated some minor hiccups, yes, which seem pretty common in this complex industry. Sources mention things like delays in integrating some of the new Amazon cargo jets and retiring one jet or delaying the start of 737-900 service back in May 2025.
Okay, sounds like typical operational challenges, fleet management stuff.
Exactly. Seems like part of ongoing fleet management and expansion, rather than indicating deep systemic issues.
And it seems they're also investing in the customer side. Mobile app, marketing.
Precisely.
Right.
They launched a new mobile app back in May 2024, clearly aimed at improving the customer experience, streamlining interactions for passengers.
Modernizing the interface.
Right. And on the marketing front, we saw efforts like putting the Minnesota Golden Gopher Athletics livery on a plane in December 2024. Aims to enhance brand visibility, local engagement, especially in their home market.
Connecting with the local community.
Shows ongoing efforts to strengthen their market position and customer loyalty.
Okay. And any other big corporate finance actions besides the regular operations?
Yes. One major event, which ties back to our earlier discussion on ownership and insider selling.
The secondary offering.
Exactly. That secondary public offering and a concurrent share repurchase happened in February 2025. This directly relates to that huge sale by SCA Horace Holdings, LLC, which offloaded over $100 million in shares.
So the company bought back some shares at the same time the big holder was selling.
That's what concurrent share repurchase implies, yes. This kind of event can significantly impact a company's share structure, its public float, shares available for trading, and overall ownership dynamics. It's something sophisticated investors pay very close attention to.
So it sounds like they're not just flying planes, but strategically managing their finances, operations, and public perception pretty actively.
Seems that way.
What about a broader market context? Were things generally good for airlines during this period?
There were indications of that, yes. The sources mention a general positive sentiment for U.S. airlines around July 2025. One headline noted a surge after Delta's outlook lifts fortunes across the whole sector.
So a rising tide lifting all airline boats, potentially.
It suggests that SNCY may well have been benefiting from broader industry tailwinds during parts of this period, which can certainly amplify the positive effects of their own internal strategic moves and successful execution.
Okay.
In essence, these events paint a comprehensive picture. You see a company actively evolving its business model with cargo, seemingly executing well on key partnerships like Amazon, consistently beating earnings expectations, and navigating operational complexities within a dynamic industry landscape. The financial numbers and the stock performance we've looked at are really a direct reflection of these strategic operational decisions playing out in the real world.
Okay. So what does this all mean for you, our listener, trying to make sense of SNCY?
On the positive side, the strong projected growth in EPS is impossible to ignore. That robust 56% expected next year, over 30% annually projected for the next 5 years. That's compelling, a very attractive growth outlook.
Driven largely by?
Driven unequivocally by the promising and rapid expansion of their cargo business, especially that Amazon partnership, which, as we saw, is already yielding record cargo revenue. It seems to be working.
What else on the plus side?
Their consistent track record, recently at least, of beating earnings estimates quarter after quarter. That builds significant investor confidence, shows management team capable of delivering, maybe even under-promising and over-delivering.
Good execution.
Yes. And furthermore, some of those valuation ratios, like the very low PEG ratio of 0.37, potentially signal that the stock could be undervalued relative to its future growth prospects. Suggests maybe an attractive entry point for growth-oriented investors if they believe the projections.
Okay, so strong projected growth, cargo momentum, earnings beats, potentially attractive valuation. Sounds pretty good.
On the other side of the ledger, one of the most significant considerations, which we explored in detail, is that pattern of widespread and consistent insider selling.
Yeah, that definitely caught my attention.
While it's important to remember insiders sell for many reasons, as we discussed, personal finances, diversification, options.
Right, not always a negative signal.
Correct. But a net negative insider transaction percentage, and particularly large sales from multiple high-level executives, including the CEO and CFO, especially around the same time, it's undeniably a data point that warrants careful attention. It's not a definitive sell signal, but it's certainly a yellow flag.
Something you need to weigh against the optimism.
Exactly. You, the listener, should weigh it against those positive forecasts and analyst recommendations. It forces you to ask the question, if the future looks so bright, why are some of those closest to the company reducing their exposure, even if just moderately?
Fair question. What else?
Additionally, the stock's higher volatility, evidenced by that beta of 1.62, it just means it can experience more dramatic price swings up and down, while that offers potential for higher returns if things go well.
It inherently carries higher risk if things go badly, or even if the market just gets choppy.
Precisely. Higher risk during downturns. Finally, while common in the airline industry, their liquidity ratios being below one quick ratio 0.59, current ratio 0.63 mean their short-term operational cash management needs careful, continuous monitoring. They rely on smooth operations to keep cash flowing.
Okay, and the mixed stock performance history itself reflects some of this complexity.
Exactly. The stock's mixed short-term versus longer-term performance reflects these underlying dynamics, the strategic shifts, the risks, the opportunities. It all makes it a rather nuanced investment proposition.